Hello everyone, welcome to StudyIQ. So today we'll be talking about economics. We have already started with taxation, and in that module we have already covered the important terms related to taxation, okay, where we have discussed about surcharge, cess, tax, and everything we have discussed in detail. Now in this session I'll be talking about direct taxes, okay. So we are going to cover all the different types of direct taxes, which includes, we'll start with personal income tax, okay, then we will talk about wealth tax, okay, where it is imposed and why it is abolished, and everything will be discussed. Then we'll talk about corporate income tax, we will talk about minimum alternate tax, MAT, then we'll talk about AMT, okay. We will also talk about gift tax, we will talk about dividend distribution tax and what are the Kelkar committee recommendations which is related to dividend distribution tax, how is it promoting triple taxation, and after Kelkar committee, even then also after making some modification, there is a double taxation which are involved in dividend distribution tax, which is one of the problem here. We will be discussing about that, and then we will talk about capital gain tax, we'll talk about securities transaction tax. Okay, so we will talk about house tax, the tax which you are paying for your house. We will also talk about commodities transaction tax, and then I'll tell you how is it different from indirect taxes. Although when you're talking about commodity, you may understand it as goods and services, but that is not the case here. We will be talking about that because this is going to be related to futures, okay, not actual trading of goods and services like indirect tax case, okay. We will also talk about stamp duty or stamp tax, okay. So all these are coming under wealth tax. So we will be discussing all these different direct taxes in this particular session. So if you attend the session completely, there is no point in reading any textbooks or anything else for this particular topic, and that's my promise, okay. So let's get started. We will start off with personal income tax or PIT. We have already done this discussion when we have started with the module taxation, and there we have discussed about the rebate which is there for personal income tax. We have talked about the surcharge, okay. We have also talked about different slabs and different rates of taxation, and we have told what is progressive taxes, and all those concepts are actually discussed in the first module itself. But let's go for a quick recap, okay. So what is personal income tax? It is actually imposed on the income. Now what are the different slabs? See, 0 to 2.5 there is no tax, so exempted, and 2.5 to 5 lakh you are taxed at 5%, then 5 to 10 lakh you're taxed at 20%, and above 10 lakh the tax rate is actually 30%, okay. Then I have already discussed that there will be a tax rebate up to 3 lakhs, and what is that tax rebate? 2,500 tax rebate is there up to 3 lakhs. That means if you see, if your income is 3 lakh, okay, you can see here in that 3 lakh, this 2.5 lakh is not taxable income. So 50,000 is what taxable income, out of which what tax you need to pay for this to 50,000, you need to pay 5%, so it will be coming around 2,500. So if your income is 3 lakhs, this 2,500 is what you're supposed to pay, and there is a rebate of 2,500. So effectively you don't want to pay any tax up to 3 lakh. But your income is 3 lakh 1, then you are supposed to pay this 2,500 because it is crossing the 3 lakh, and you need to pay 5% for this 1 rupee also. That means 0.05 paisa you need to pay. So I hope that is understood. That's what I mean by tax rebate. Then there is a surcharge also which is imposed. What is the surcharge? 50 lakh to 1 crore there will be a 10% surcharge, and if it is 1 crore above, that means I am talking about super rich people, their income is above 1 crore, so they having extra surcharge of 15%. Now understand, this 15% is not 30 plus 15 equal to 45%. That's not the case here. This 15% of this 30, okay, and similarly this 10% of this 30. So 10% of 30 means it's 33% you need to pay under this category, and this 15% of 30, that is 4.5, so 34.5%, not that 45% you need to pay. So that also need to be made clear. Now let's suppose your income is 7 lakh. Now how much tax you need to pay in this case? We have already understood that 0 to 2.5 there is no tax, so that is exempted. Then 2.5 to 5 lakh, that means this 2.5 lakh you need to pay tax. So 2.5 lakh you need to pay tax at the rate of 5%. So you will be paying around 12,500 for this 2.5 lakh. And the next 2 lakh, how much you need to pay? You need to pay at the rate of 20%. So when you calculate at 20%, you need to pay 40,000 as the tax for the rest of the 2 lakh, which is above 5 lakh. So effective tax burden for you will be 52,500 in this case if your income is 7 lakhs. So I hope that is clear. Okay, so that's about personal income tax. Now let's move on to wealth tax. Okay, wealth tax. Now one thing that you need to understand is it is actually imposed by central government. Okay, but one very important fact is that it is not imposed on house. Okay, so it is not imposed on house or property. So it is not imposed on house or property because house, property, buildings and everything is actually given to state. So the state imposing tax over the house, property, buildings and all those things, and the municipality is collecting those taxes. Okay, so that is not included here. So what you can say is it is imposed on, wealth tax is actually imposed on non-financial assets, non-financial wealth except house or property. Okay, so I'm talking about gold, cash, etc. So this is where wealth tax is imposed, and recently government abolished this wealth tax. Now what do you think will be the reason for abolishing this tax? Because you know the revenue collected from wealth tax is very minimum. Why the revenue collected from wealth tax is very minimum is because you see most of the revenue you'll get from this house or property, that is actually given to state government, and what you can get from this gold, cash, etc. Okay, and you know when you are holding this gold and cash, it is very difficult to know how much gold and cash you are holding, and nobody is going to disclose the actual amount of cash or gold is with them, right? So that is the reason why wealth tax is actually abolished. You can see that you know the charges or the investment which is there for the government for collecting tax is more than the tax collected. So there is actually no point in imposing this wealth tax. Rather, see, if you remember when we discussed about the super rich person just before in personal income tax, if your income was between 50 to 1 crore, there was a 10% surcharge extra, right? And 1 crore above, you have 50% extra, 15% extra you need to pay. So when this wealth tax is abolished, the surcharge was imposed. What is the assumption? Assumption is these people having some extra cash with them. So this is actually imposed in lieu of this wealth tax. See, otherwise nobody is going to disclose this gold or cash with them, right? They'll pay 30% and they will keep all this cash and gold with them, but it will not be disclosed. But now here, this is actually imposed on those super rich person with the assumption that they are having cash with them. Okay, so I hope that is clear, and that is the reason why these taxes are known as presumptive taxes. The assumption is there. It's all about assumption. So these taxes are also known as presumptive taxes. So I'll write it down. What do you mean by presumptive taxes? You can just write it down also. Presumptive taxes. See, surcharge is a clear-cut example of presumptive taxes. What is a presumption? The assumption is that they are having cash with them. So after abolishing the wealth tax, it was imposed. So I hope it is clear. I'll write it down. What is presumptive tax? These taxes are imposed on the basis of assumption of the government that a person or firm is not paying adequate taxes as per his or its, if it is about firm, it's paying capacity. See, it's not only for persons. The surcharge is imposed on persons. Similarly, you can see some MAT, AMT, etc., which are imposed on minimum alternate tax, which is also a kind of presumptive tax. So we'll be discussing that shortly, so you'll understand. So what do you mean by presumptive tax? This is all related to this assumption. What is the assumption? Assumption is that the person is not paying adequate taxes on the basis of his capacity. So by keeping this assumption, government is imposing a surcharge. Okay, so surcharge is a clear-cut example of a presumptive tax. So which among the following are presumptive tax if you get a question? Surcharge is one example, and the other taxes which are coming under this will be discussing shortly, so that you will get that question. Okay, so you need to know what you mean by presumptive taxes and how surcharge is a presumptive tax. I hope this point is clear now. So MAT, AMT, alternate minimum tax, surcharge, all are examples of presumptive taxes. Now next we will discuss about corporate income tax. We have already made this discussion before. Okay, so corporate income tax. Now we will talk about two companies here. Domestic companies, they have to pay 30% flat, okay, of their profit, and foreign companies, it's 40%. Okay, so you can see here tax burden is actually more for foreign companies. Now the surcharge will be on this companies also. You can see here the surcharge is applied like this. If we divide like this, if the profit is 1 to 10 crore, and if it is above 10 crore. If it is 1 to 10 crore, 5% for domestic companies surcharge, and 2% for foreign companies. And if it is above 10 crore, 10% for domestic companies and 5% for foreign companies. So you can see here when I'm talking about surcharge for the companies, it is actually less for foreign companies. The reason is already they are having the higher tax burden. You can see 40% is what they are supposed to pay. Now see, when I am talking about this 5%, it is not in addition to 30. It is not 30 plus 5. It is 5% of 30. What is that? It is 1.5, right? So 5% of 30 is 1.5. So here the tax burden will be effectively 31.5 if it is between 1 crore to 10 crore. Now here it is 2%, so it will be 2% of 40, that is 0.8. So effective burden will be 40.8%. So I hope this is clear. So here domestic company is 31.5 if it is between 1 crore to 10 crore. If it is less than 1 crore, no problem, 30%. If it is foreign companies, 40.8. This 10% also of 30. So here it will be 33% effectively for domestic companies if the income is greater than 10%. And here it is 5% of 40, that is 2. So here it will be 42% is the tax burden if it is more than 10 crore for a foreign company. So I hope this point is clear for all of you. Next we will discuss about, again, very important one. We will talk about MAT, minimum alternate tax. Okay, so minimum alternate tax. So when it was introduced in 1996. Now what is the concept? I'll write it down, then I'll explain this. Okay, so it is imposed on those firms whose taxable income is less than certain percentage of their book profit. I'll tell you what is book profit and everything. Okay, so if their taxable income is less than certain percentage of their book profit, it is imposed. Such firms have to pay MAT at 18.5% of book profit. Okay, so if your taxable income is less than a particular percentage of the book profit, then in that case MAT is imposed and you have to pay a flat 18.5% of book profit. Okay, otherwise you need to pay 30%, here 18.5%. Now what do you mean by this taxable income? What is this book profit and everything? I'll tell you. Okay, see, in this case it is not both. You don't want to pay CIT, you need to pay MAT. Okay, so you have to pay either of them, whichever is higher. So firms have to pay CIT, corporate income tax, or MAT, whichever is higher. It is not both. Okay, not first is 30%, then 18.5%. That's not the case. It is 18.5% flat. If that is more, then you need to pay MAT only. If CIT is more, then you need to pay CIT. You don't want to pay MAT. I'll tell you the logic. Okay, so let's suppose your book profit is 10 lakh. Book profit is 10. Book profit means what you actually earned in total. Okay, so book profit is 10 lakh. Now company can show certain deductions, and these deductions can be in the form of reinvestment, R&D. You can show some depreciation, and in all these ways you can show these deductions. Okay, so let's say the company is showing deduction of 9 lakh. Now it's up to the company. Company can manipulate also. Okay, so then what is your taxable income? Taxable income is actually book profit minus deduction. So taxable income here will be 1 lakh. Okay, so now in this 1 lakh, if you are paying, so this is your taxable income. Now see, this, because of this tax provision, because of this deduction thing, company can take undue advantage, and company can show a lot of deductions. Okay, so that manipulation they can do. So in this case, I've shown maximum deduction, and I've reduced my taxable income to just 1 lakh. Now in this case, what is the CIT I'm paying? CIT at 30% will be, I have to pay 30,000. Okay, so in this case, now if you calculate MAT at 18.5% of book profit, CIT is 30% of taxable income, MAT 18.5% of book profit, that is going to be 1,85,000. So whichever is higher, MAT is higher here, so you need to pay MAT. So the government will say, okay, in this case you don't want to pay CIT, instead you pay MAT. Now what is the logic here? See, the deductions and everything, it cannot be 30% is okay, even up to a 20% deductions you can manage, but even up to, government is allowing up to 18.5% deduction, but beyond that means it is unreasonable, and that is not genuine. So the assumption, this is also an assumption, right? The assumption is that it is some manipulation is actually happening. It is not genuine deductions. There can be deductions, there can be in the form of R&D, there can be in the form of depreciation, and it can be in the form of reinvestment and everything, but it has to be genuine. So government is allowing up to 18.5%. And if it is reduced less than 18.5%, actually the assumption is that you are doing some manipulation. So that is why I told you this is also a presumptive tax. So what is the assumption here? That manipulation might have done if it is reduced less than 18.5%. So government is going for a flat tax of 18.5% as MAT. So I hope this is clear, just to avoid this manipulation in terms of deductions. Okay, rather the companies will reduce the taxable income, so that has to be avoided. So I hope this point is clear for all of you. That is what MAT. Now next is AMT, alternate minimum tax. Alternate minimum tax. See, it is actually imposed on non-corporates. Let me write it down, then we'll explain. Imposed on non-corporates. When it was introduced in 2012. The MAT was introduced in 1996. I hope I have told that point. So it was introduced in 2012. See, what do you mean by non-corporates? I'm not talking about this limited liability companies, not a limited company. I'm talking about partnership, proprietorship, etc. having a turnover or a profit over 20 lakhs. Okay, so non-corporates having a profit greater than 20 lakhs. So they are earning too much, and their tax burden they can reduce by different means. So what the government will do, it is imposed at the rate of, this AMT is imposed at 18.5% of book profit. Okay, so they also need to pay 18.5% of book profit flat, because they are not corporates, right? So corporate income tax is not applicable. This 30% is not applicable for partnerships or proprietors, but there can be certain partnership or proprietor firms which are having huge profit and turnover than a limited company, than a corporate, right? So in those cases, if it is above 20 lakhs, AMT is applied at the flat rate of 18.5%. So that's about alternate minimum tax introduced in 2012. I hope that is also clear. Next is gift tax. Gift tax. Okay, now from whom, so you are getting some gift, so from whom it is collected? Is it from the person who is giving the gift, or is it from the person who got the gift? So it is actually collected from the recipient. Okay, so imposed on recipient. How it is imposed? Actually, this gift is considered as an income and he have to pay income tax, personal income tax for the gift he got. Okay, so it is actually assumed as income, so you have to pay income tax. Now there is an exemption limit. What is the exemption? Exemption is up to 50,000. So up to 50,000 you don't want to pay anything, but if it is above 50,000 you have to pay. If it is 50,001, you have to pay for entire 50,001 rupee. Okay, so I hope that is clear for all of you. Now see, certain cases are also exempted, like the gift from your parents, close relatives, blood relatives. Okay, even dowry is also exempted from gift tax. Okay, so I hope this is clear. You just need to know it was collected from the recipient and it is considered as the income of the recipient. Next is dividend distribution tax. So there are certain problems which are associated to dividend distribution tax which we need to discuss here. So dividend distribution tax. Okay, so we have already discussed corporate income tax. So I'll tell you how is it different from corporate income tax. So let's suppose this is the turnover of the company. Let's say 10 lakh is the profit of the company. Now out of this, a flat 30% you have to pay as corporate income tax. So that is over. Now out of the 7 lakh which is left out, let's say this 22 lakhs you will keep it as undistributed profit. Okay, so that will be reinvested. So this 2 lakh is going to be the undistributed profit, and this 5 lakh is what you are going to distribute as dividends to the shareholders. So this 5 lakhs you are going to take out and you'll distribute to the shareholders. But when you are distributing this dividends, you will be taxed at 15%. So that is what dividend distribution tax. So what is 15% of 5 lakh? That is 75,000, right? So 15% is 75,000. So effectively you can actually distribute only 4,25,000. So I hope this point is clear for all of you. Even though when you are seeing here it is 5 lakh which is going to be distributed, but there is a tax of DDT which are imposed on that income, that distribution time. So you are supposed to distribute only 4,25,000. So it's not that if let's suppose 100 shareholders are there, it is not 5 lakh divided by 100, it is 4,25,000 divided by 100. So effectively one person is getting 4,250, not 5,000. Okay, so one dividend is not 5,000, it is 4,250. That 15% is actually deducted. Okay, so what is the problem here? See, the problem here is already there is a taxation. This income is already taxed. Once it was initially taxed at CIT, this 30%. Now again 15% when you're distributing. Now one more tax was there from the shareholder also. For this there will be a tax. So there is actually triple taxation. Now why this 15% tax is actually imposed? The 15% tax is actually imposed to discourage the dividend distribution, because when the 15% is imposed, the dividend distribution will be reduced and it will be going as the undistributed profit, or it will be going as a reinvestment. So it is basically to promote reinvestment and to discourage the dividend distribution. This tax is imposed, but that is actually double taxation. Then it was again tax from the shareholder, so that is actually a triple taxation. And there was a committee appointed the committee is known as Kelkar committee. Kelkar committee, what was the recommendation is this has to be abolished. DDT for companies and shareholders to be abolished. Okay, what is the reason? The reason is actually, see, I have already told this point, there is a triple taxation. Firstly, the 10 lakh income is actually taxed at 30%. So that is in terms of CIT. Then again from this 5 lakhs, there is a 15% tax. Okay, in terms of DDT, then again from the shareholders. So there is a triple taxation that is not possible. Okay, so that is actually the logic of this recommendation. And what the government did is they have abolished this one. So now there is no triple taxation, but they have maintained this. The companies have to pay during the time of dividend distribution, but it is abolished from the shareholders. But still, there is a double taxation because you are paying here and then you are paying at 15%. These two are still there. Now next is capital gain tax. Capital gains tax, CGT. It is actually imposed on increase in value of assets. So let me write it down. Imposed on increase in value of assets. Okay, it is imposed at the time of sale. Now the rates actually varies. There are physical assets and there are financial assets. Like physical assets means I'm talking about land, buildings, etc. The financial assets are the shares, etc. Okay, and the tenure, see, you classify it as short term, long term. That also, in case of physical, the terms are different, and in case of this financial assets also, when you're classifying the short term, long term are different. See, above 1 year, in case of financial assets, it's considered as long term. Okay, in case of physical assets, it's 3 years. So in that way, it is different. And when you're talking about shares, okay, the capital gains tax for shares, in case of long term, that means after 1 year, it is not there. Okay, so it is actually abolished. That means you don't want to pay capital gains tax for the shares after 1 year. That means if you bought a share, let's say 1 lakh rupees share you bought, and it increased to 1,20,000. So if you are selling this share after 6 months, you have to pay this capital gain tax. But if you are selling this share after 1 year, there is no capital gain tax because it was abolished. It is not imposed on long term cases. Okay, so long term, the capital gain tax for shares is not there. So I hope this is understood. Capital gain tax is actually imposed on increase in value of assets. You just need to have a rough idea. This long term is different in case of financial assets and physical assets. Okay, and then you just need to know that in case of shares, long term, there is no capital gain tax. Now next is house tax or property tax. When I've discussed about wealth tax, I have already discussed this point. So what is the difference between wealth tax and this? Wealth tax is actually collected by center. This is actually collected by municipality. It is under the domain of the state. Okay, and wealth tax was abolished, but it is still there, and this is one of the major source of revenue. Okay, so I hope this point is clear. So there is no point in discussing too much about this. It is common for all of you, and it's known to all of you. Okay, but you just need to know it is not part of wealth tax. That is different. Wealth tax is collected by center and it was abolished. This is collected by the state, okay, or municipality. Next is Securities Transaction Tax. Securities Transaction Tax, STT. When it is imposed when you are buying and selling a share. So it is actually collected from the buyer as well as the seller. So imposed on buying and selling of securities in stock exchanges. Okay, so what is the rate? The rate is actually 0.1%. Okay, so let's suppose you are buying shares worth 1 lakh rupee. So you will be taxed 100 rupees both from buyer and seller. So 0.1% from the seller and from the buyer. Okay, so 1 lakh means 100 rupee you need to pay as the tax during the time of buying, and during the time of selling also the seller have to pay the tax. So if the 1 lakh transaction is done, the tax collected is actually 200 from the buyer and seller together. Okay, now it is completely different from capital gains tax. See, this was actually imposed during the time of buying and selling. Now you see that share, that person who is selling the share, let's suppose he bought this share 6 months back, let's say he bought, now take this case, person A bought the share of 1 lakh, okay, worth 1 lakh, and after 6 months, if he is selling, he is getting 1,20,000. Okay, if he is getting 1,20,000, so for this 1,20,000, you have to pay 0.1% tax, and that is what Securities Transaction Tax. That tax is paid. Apart from that, there is actually a capital gain here, that is 20,000. So you need to pay capital gains tax for this 20,000. Okay, if this transaction is actually happening in 6 months, 7 months, 8 months, 9 months, 11 months, etc. But if this is happening after 1 year, I have told you long-term shares are excluded or exempted from capital gain tax. So in that case, you just need to pay 0.1%. You don't want to pay tax for this capital gain. So that is clear. That is what capital gain tax, and that's the difference between capital gain tax and securities transaction tax. Both are different. Okay, capital gains tax is not only for shares. There can be many other gains which are possible. There are many financial assets. There are many other physical assets also in which capital gains tax is applicable. Just that I have taken the example of share. You should not be confused with capital gains tax and securities transaction tax. So I hope this point is clear for all of you. Next is commodities transaction tax. Commodities transaction tax. See, it is imposed on futures trading in commodities. Now, futures trading means, why it is not a indirect tax? If it is commodities, you may think about goods and services, okay, but it is actually not on goods and services. It is futures trading, so it is all related to speculation on goods and services, and that is coming under direct taxes. So commodities transaction tax is a direct tax, and I'm classifying under direct tax. Next is easy one, the 12th one, that is stamp duty. It is imposed on purchase of property. Okay, it is imposed only on buyer. Okay, so it is imposed only on buyer. See, when we discussed about securities transaction tax, that is also a kind of, stamp duty, but in that case it was imposed on both buyer and seller. But here it is on property. It is in case of physical asset, and it is only imposed on buyer. So I hope all these are clear. We have discussed about all the different types of direct taxes. 12 types we have discussed. In the next session, I'll be talking about indirect taxes. In between, I'll be talking about history sessions also. So if you have any doubt, you can get in touch with me. This is my Instagram ID. So I hope to get connected with you. So any doubts related to economy, history, sociology optional, or rather any doubts related to civil service preparation, you can get in touch with me. Okay, so I hope to see you guys